US data out yesterday, such as building permits, housing starts, and production, all came in lower than expected. Joining me on the line now to discuss this data is Alasdair Cavalla from CEBR in London. So, Alasdair, could you expand on the data and tell us what it means for the US economy?
Sure. Our assessment of them is that they aren't too concerning for the general picture of the US economy, which we have a fairly bullish view on at the moment. Firstly, the monthly data tends to be pretty volatile, and secondly, there's a number of other factors which have been behind the industrial output figures being weaker than expected. They rose slightly, but they were held back by the stronger dollar and a slower global outlook. And there was also a labour dispute at one of the West Coast ports. So we'd say that this doesn't have such a strong meaning for the health of the U.S. economy, because there's a few one-off factors or external factors which are causing the data not to fully reflect that. In general, the more substantive measures like the consumer confidence and the health of the labour market are making our view of the US economy as a whole a lot more benign than these data suggest.
FOMC minutes released yesterday suggest the Fed are not in a rush to raise interest rates, as they believe this could harm the recovery. Could you share your thoughts on this and tell us what other aspects the Fed are looking at in order to boost economic growth?
Sure. We think the Fed is correct not to rush into raising interest rates. It may lose some credibility over the fact that it had scheduled in the first rate rise to be 6 months after the end of tapering, which would be around the middle of this year. But it may well end up pushing that date back, and we would expect this to be a good move. Ultimately, there's no reason to raise the interest rates until there's this evidence of a sustained pickup in inflation, and neither from wage growth in the US, which may be starting to pick up, but isn't fully at the moment, and nor from the commodity prices, the oil price, and so on, is there enough evidence to point to a quick tightening in monetary policy. So we think the Fed are correct to do this. The other aspects they're looking at, of course, are wage growth, as I mentioned, and also other aspects of the labour market, such as the participation rate, starting to look a little bit better now after a long decline. Also, the quit rate is something which we know Yellen uses to judge whether workers are feeling confident about the labour market or not.
In your opinion, what can we expect from the next meeting?
Well, at the moment, the Fed's in data-dependent mode, so it's just responding to the data as it comes. So it very much depends on what data comes out. Since the last meeting, there's been a very good jobs report out with a large job creation figure and improvements in both wage growth and the participation rate. So that should be that should help its view to that the economy is broadly on track as they're expecting. But it depends what comes out in the next few weeks between now and then.
And finally, what are the key US events traders should be keeping an eye on next week?
Well, consumer confidence comes out on Tuesday. That's important not only for the US economy, but for the whole world's economy, since so many big exporters now are looking for the US to kind of take up the weakening demand in their own country. And the stronger dollar will help that, of course. And there's also consumer price inflation data coming out on Thursday. we'd be expecting the monthly inflation rate certainly to fall and the yearly rate to fall as well.
Thank you for your comments, Alasdair. That's all for today. So from me, Louise Macaulay, it's goodbye for now.